So today we're going to talk about something major that's going on in the stock market this week. In fact, not something that's going major this week, two major things that are going to be happening this week, which is going to be really important for investors and will also probably dictate where the stock market goes, especially in the longer term as well as the short term. So it's really key to talk about this. So we're going to take a look and see what this is, because no one is speaking about how important this is going to be for the stock market and how big this actually is in terms of news as well. Before we get on to that, if you haven't already, if you're on the Patreon, go watch the stock request video out. We did 3 stocks on there. And if you do want to join the Patreon and see 2 exclusive videos a week, join the Patreon and you get to see videos like that, like the stock request, where members of the Discord get to vote for 3 stocks for me to take a look at. This week it was XP Factory, On the Beach and Keyword Studios. And as well as that, if you haven't already, we dropped a live Q&A session as well for 14,000 subscribers last night. So if you do want to go see that, it's on the video, it's on the channel somewhere. It's around about 45 minutes long, and thank you for giving me 14,000 subscribers. Hopefully the 15,000 subscribers isn't too far away, and maybe then we can do another live Q&A session as well. But if you look at the markets at the moment, the markets have been doing really well. And if you look at the S&P 500, it's up 12% year to date. That's a very good year. That's higher than the normal average return in the S&P 500. And I remember at the start of the year when I did my 10 predictions, my 10 predictions were to see the S&P actually return 15 to 20% in 2023. And obviously that was in a time in December when stocks were going, ooh, and they were taking a bit of a nosedive. And one of the reasons why I had the confidence to predict the S&P 500 to do really well is because I like using historic data. Quite a few people like to use charts and say, oh, this squiggly line says that these stocks are going in this direction. I'm not a big fan of that. I think you can always draw squiggly lines to suggest where it's going to go to suit wherever you're wanting it to go. I like looking at history. I like looking at history and going, okay, when the stock market is normally in this situation, where does this market normally go? And I was looking at inflation. And the inflation was the key part, because inflation was the main reason why the stock market and the economy was nosediving in 2022. Inflation was going sky high, costs were going up, companies were struggling with costs. That also meant interest rates were going up. Companies don't like when interest rates go up. It's very hard for them, the housing market. It's hard for companies to shuffle around for getting cash or having to increase interest rates on the cash they have lent. It makes it a really difficult time. Now, when that issue goes away, what happens in the stock market? Well, we saw that when inflation peaks, which it peaked in June last year, which was at 9.1%, when inflation peaks, the average return in the S&P 500 12 months on is 13%. Now, funny enough, we're exactly 12 months on since that time frame. And what happened in the S&P 500? The S&P 500 returned 12.41%. So when you look at historic data, this was wrong by 0.6%. How amazing is that? It was nearly pretty much bang on, only 0.6% off historic data. And that's why I love historic data. I like looking at what is the return normally when this event happens. And if you looked at that event and you looked at what I was saying a year ago, that is what has basically happened in the next 12 months. So that's why I had confidence for the stock market to do really well this year. Obviously that major issue is resolved and inflation has peaked, and we're seeing inflation rapidly coming down now. And obviously we want to see inflation get to the 2% that the Fed is targeting. Now, if you look at last month of inflation, it was 5% and it only had a slow drop to 4.9%. The reason why oil jumped up in that period of time, and that's why inflation was a little bit slower to come down. Now, actually, it wasn't actually supposed to come down. Inflation was actually supposed to, I believe it was supposed to go up last month, but it still came down. Now, looking at this month, this is what's even more impressive. If you look here, inflation is now predicted by Trading Economics to come in at 4.3%. Only 2 weeks ago, this was once again, I think 4.9%, and then it went down to 4.7% last week. In the last week, this has now dropped down to 4.3%. And if you actually look at the consensus of analysts, they're expecting, and I noticed this a week ago when the first couple of projections were starting to come out, is they're now expecting 4.1%. So we're going to see another projected 0.8% drop in inflation. And this is going to come out on Tuesday. So this is another major drop in inflation. The fact that we are very, very close to 3% range in what will be for May's data in June is fantastic. And we were hoping to see 3 by the end of the year and potentially 2. There's no doubt we're hitting 3. We're going to hit 3 probably by the next month, by July. We're going to hit 3% by July. So it's more of a question, when are we going to hit 2% now? Because we're going to hit 2% this year. And that is scary how rapid that has come down. I mean, it's fantastic. It's fantastic that inflation has come down that much, but it's faster than what everybody was projecting. It's faster than what the Fed were projecting, and it's faster than what even I was thinking. And I had quite aggressive targets, and that's absolutely fantastic. We're only going to be 1.1% away, really, from 1.2% away from the Fed's target of 2%. That's absolutely fantastic news. And the fact that inflation is dropping this much and no one's talking about it, it's crazy. It's crazy to see that this was such a talked about topic only a year ago, and now that it's coming down on if it was going up this rate, everybody like, wow, inflation's going up this much, but because it's coming down, no one's talking about it. No one's talking about it. It was only supposed to be 4.7%, and it's dropping rapidly once again to 4.1%. And we're going to see the 3% by summer. We're going to see 2% by the end of the year. And I actually think, and I pointed this out on the Discord I think it was either last week or the week before, if you actually look at true inflation, this is no surprise. If you've been looking at true inflation recently, you will notice that inflation has been dropping rapidly. And the thing is that's really positive is that through May, if you look at true inflation, you can see the little bump up that we had through April, and that's why obviously the last inflation report didn't drop as much. But the good thing is, as the month of May has continued, look at how the inflation has dropped. And then once we've got into June, the good thing is inflation has dropped once again. So realistically, when we look at the inflation data, inflation more realistically right now, because this is a lagging indicator that the Fed are using. I mean, this is lagging. You don't actually get the true inflation numbers until a few months. Right now, realistically, we're probably already in the 3% range. We're probably actually realistically very close to 2% range. And looking at what true inflation is, I think we can see the 4.1% on Tuesday. I would not be too surprised looking at how quick inflation is dropping if we do see the 4, if we even see a 3. I mean, if we see a 3, imagine what the market rally will be. That'll be very, very impressive for the stocks. And then that leads on to Wednesday. What's happening Wednesday? The Fed. The Fed are going to be putting the new interest rates out. And this is potentially the first time we're going to see the Fed pause for 18 months. The interest rates have been put up rapid. The quickest they have been in history. They've gone up and up and up and up. But this potentially, on Wednesday, could be the pause of the interest rate hikes. Now, there is still a 1 in 4 chance, 25% chance, that the Fed do increase interest rates. And if that was to happen, you watch the market will be like, you're kidding me. No way the Fed not pausing this time. But obviously 75% are saying that they're going to pause. And I think they've got to. I think the Fed have been very slow once again to react. I think they were slow to put them up. I think they were slow to bring them down. I think the Fed should have paused last time. I think I would have made the case they should have paused the time before that, because you got to realise that Fed, when they put these interest rate hikes up, it takes a while for them to settle into the economy. There's no point in them now putting these interest rate hikes up, because realistically right now inflation is going to be at 4.1%. By a month's time, we're going to see the interest rates in the inflation into 3% range. It's going to be 1% off the target. So there's no point waiting for that, because that's a lagging indicator. So all they're going to do then is damage the economy. They might as well pause now and sit back and go, we think we're okay here, and let everything, the hard comps, start doing the rest of the work, and that will eventually bring it down into the 2% range as it overlaps some of these numbers. There's no point carrying hiking up interest rates, because that's only going to put more pressure on the economy and cause more pain for the economy. And we could even see deflation there, which is definitely not something that we want. So definitely we should see the Fed pause this time. And if we don't see them pause, then that's going to be a little bit worrying there. But you never know. I can't trust Jerome Powell. But the combination of that, if we see inflation this week coming to like the 4%, if we see a 3, that'll be absolutely amazing. If we see the Fed pause, this is really exciting. We should see the stock market really get excited, going, the Fed have finally paused now. Inflation is still rapidly coming down. We should see the market get actually really excited this week. And also looking at the future, what that also means for the stock market in the future is this. We talked about what the big pressure of inflation were. And if inflation was taken away from the stock market, what potentially the stock market would return a year ago. Now we talk about the Fed. The big issue is the Fed. When the Fed going to finally pause? And this is why it's also key for the Fed to pause. Because when the Fed pauses and doesn't increase interest rates anymore, what is the average return? Let's look at history once again. Well, the average return is 14.8% following the end of a rate hike cycle. So when the Fed pauses, the return is 14.8%. Now that's more than the actual, only slightly, by 1%. But that's more than when interest rates actually peak. So when interest rates peak, we see an average return of 13%, and we've got 12.4%. When the Fed pauses, we then see the stock market return even more, up to 14%, as we saw here, 14.8%, nearly 15%. And obviously, if we saw the stock market go up around 14%, that would actually put the stock market at all-time highs in 2024. In the summer of 2024, we would see the stock market at all-time highs. And why is that key? Why would the Fed pause cause the stocks to rally so much? Well, because interest rates, when people have this misconception that stocks cannot do well in a high interest rate environment, they can do well. Companies can do well in high interest rates environment, and you got to realize historically we were really low for many years. We're getting a bit more of a realistic interest rates that we should have been at. I think it's still slightly high, and it should have come down a little bit, and the Fed should cut at some point. But we were just historically low, and these interest rates are still not too bad realistically compared to history. And the big thing is that why companies and the economy would like pauses in the interest rates is because companies then know what the interest rate's going to be. They can start planning out further down the line and not worry about if the interest rate's going to be higher. If they know what the interest rate is going to be, they can start planning about if they're going to lend money, what they're going to lend money at, what if they want to lend more money, what the rate's going to be. That's 100% better what companies like to be doing, and they can weigh that up. And it's the same with like the housing market as well. When you're buying a house, if you know what the interest rate's going to be, you can then justify, we can buy it. But the problem is that if you want to buy a house and then your interest rate in 2 years' time can be so much higher, that's going to be an issue. If you want to buy a house and you plan in January and then you get the interest rate in July and it's gone up so much since that time frame, it's a lot harder to plan. And that's why people like knowing what interest rate's going to be, and that's why you'll see things do really well when interest rates are pretty much held steady. Combine that with the factor that we could see a cut, I think we should see cuts, and we could see potentially cuts start happening if inflation does get to 2%. That's another bonus that we could get that would help a rally in 2024. But when I look at historic data right now and I look where the stock market is, could we see the stock market at new highs in the summer of 2024? And I can see the stock market being at all-time highs in 2024, because you've got to think in a year's time. In a year's time, if inflation's gone, if you start thinking about this high energy situation, that's going to be resolved. If you think about all these costs that have been going up, they're going to level out. You're going to see all these pressures of energy, inflation, they're all coming out of businesses. The consumer's going to be in a good place. They're not having to worry about energy bills or their petrol prices, oil prices going sky high. That's an issue that's resolved for them. So the consumer's going to be in a lot better position. These companies are going to be overlapping really good comps. And the big thing as well is that these companies will see their earnings, because of a lot of the price rises, they're going to see their revenue up higher, they're going to see their earnings up higher. And the big thing as well is what have a lot of companies done this year? A lot of these companies have worked on efficiencies. You've seen so many companies say, we're cutting these jobs, we're saving money here. So a lot of these companies have focused on profitability and getting their profitability up. So in 12 months, what are you going to have? You're going to have all these companies that are higher prices without the cost pressures on them. And then because of work so much on efficiencies this year, you're going to see all these S&P 500 companies are going to be putting in record amounts of revenue and profit in 12 months' time. Combine that with the interest rates environment, it's easy to see why the stock market could be at all-time highs in 24 months, in my opinion. And also you got to remember that the stock market is future thinking. So by the time you get into summer 2024, all the investors are already going to be pricing in by the end of 2024. All these companies are going to put in record revenue, record profitability, unless there's any major event that happens, which can always happen. But a lot of investors will be looking at a lot of these stocks and going, in 2024 they're going to do this revenue, they're going to do this profit, and they're already going to be factoring it in of 2024 numbers. And that's why a lot of companies should go back up to, if they're doing record profit and record revenue, a lot of these companies will go back up to 52-week highs, and that's why the stock market should do well and the S&P 500 should do really well. And also in particular, a lot of stocks that are really highly sensitive to interest rate, a high interest rate environment, is small caps. Small caps are very and growth stocks are very sensitive to interest rates as well, because they are seen as more potentially needing to get capital. More than anything, this will, whereas we've seen the S&P 500 and the big companies rocket up, more than anything, this should really help the smaller caps. And then also the fact that if we see signs of recovery and potentially earnings going to new highs, the signs of an economy being really strong is always the small caps. The small caps always lead first into a sign of a stronger recovering economy, which at the moment hasn't happened as much. But then if we do see that happening, it should happen eventually anyway. So anyway, that's the video for today. Hope you enjoyed it. It's a busy week. I'm sure we'll be talking about this inflation data. I'm sure we'll be talking about these interest rates. Hope you're ready for it. Have a good one.